Appreciate it. So I'm Andrea. I am the West Coast Director who leads the division within NASDAQ for our private company focused space. So what we do at NASDAQ is, we took an initiative 3 years ago to say, how do we better support companies earlier, right? So, as we all know, the process to go public kind of starts typically 6 to 18 months, maybe 24 months before an IPO. There's a lot of ramp up, there's a lot of conversations that are had, there's a lot of decision making to be done. So what NASDAQ decided was, how can we plug into that ecosystem earlier and start supporting these companies when they're a little bit earlier stage. So at this point, the kind of companies that we're supporting go as early as a Series B company, and then all the way through to the Series F, G, H, to that IPO. And so the way we do that is actually through our NASDAQ Private Market initiative. And the whole premise of NASDAQ Private Market is secondary liquidity. So I'll talk a little bit about the background of NASDAQ Private Market as we kick things off. So the core of NASDAQ actually in general, even from the parent company down to the private market, is that we're actually a majority software company. So only 20% of NASDAQ's global revenue comes from listing. The other 80% of NASDAQ revenue actually comes from selling software. So it's not just software around, supporting an IPO, it's corporate governance, it's IR software, it's software to other exchanges across the globe that actually license NASDAQ's technology to support their own exchanges. So NASDAQ actually powers 80 stock exchanges across the world. So all of this is through licensing agreements and partnerships, and so that's where the bulk of NASDAQ's premise is, and that's why NASDAQ Private Market, our proprietary technology is all surrounding private companies, and I'll talk more about how we do that. Back when NASDAQ Private Market started, it was in 2013. I myself joined in early 2015. Back then, we decided, okay, well, how do we really do this? How do we support the private companies? What's our core strengths? And a lot of that was about facilitation. So how do we become the administrator of secondary liquidity, which is what we decided was the most exciting place to be at the time. I don't know if everyone in the room remembers, but Facebook was really, I think, a catalyst for the commercialization of secondary markets and why people are doing them, and it became very newsworthy. There was a company called Second Market that got very involved in secondary transactions involved in Facebook. And we actually bought Second Market a couple years ago, and it was really very exciting because we said, well, we have the strength of the brand, we have the strength of a network, and then Second Market had very cool technology that we brought forward to make it all very streamlined and very possible. So we acquired Second Market, and we really started bolstering our presence in the secondary space. At the same time, what we decided to do at NASDAQ Private Market was actually start winding down one of our key products. We actually used to, in the past, have a stock plan administration tool similar to what you see out there today from the likes of companies like Solium, which is a big public company, to a company like eShares, which is a mid-stage private company. So we were actually helping companies by administering their liquidity, but also tying in their stock plans and cap tables, right? So where the equity distribution falls in a private company. We decided to actually wind that product down, partner with a company called Solium, and have them kind of run the show from there, just because we knew that they were experts in the space. And so now our core competency goes back to the fact that everything we do is around secondary liquidity. So we not only administer these transactions, but we're also now in the business of really brokering them too, in a sense, because we are in a position to connect capital to those opportunities, and I'll talk a little bit more about that as we go through this presentation. So as this says, we did acquire Second Market in 2015, and that was later 2015. Since 2013, which was the inception of NASDAQ Private Market, so cumulatively between the experience at NPM and then at Second Market, we've done $5 billion in secondary transaction volume. Worked with over 120 companies at this point, and now have served over 12,000 sellers. So these are the sellers receiving liquidity at the end of the day. I do apologize if they're flooding the real estate market of San Francisco, because I always joke that that's what's happening every time we do one of these transactions. What's very, very exciting too is I don't think that there's a better time to be involved in the secondary market. And I say that in full earnest that, over the last 6 years that I've kind of been involved in this space, I've never seen a higher quarter of deals happening more than I have today. So in Q2 alone, NASDAQ Private Market has facilitated about $1 billion. Just this quarter alone. Last year, cumulatively, was a little bit of a slower year, right? We had the election, we had stuff going on overseas. It was a slower year. So last year, in aggregate, we did $1 billion in volume. This year alone, Q2 has been $1 billion. And I think that is cumulative to be around 25 individual company transactions. So the whole point of what NASDAQ Private Market does is that we're not just coming in to say, hey, here's a buyer and a seller in a private company liquidity transaction. We go to the company, we're supporting the company. We are the advisor to the company. I am the shoulder that they call to cry on at 9 p.m. the night before a transaction goes live, and they're saying, should we really do this? You know, it's been a year in the making. We've put this whole transaction together, this whole big deal. You know, 1,000 of our employees are going to receive liquidity at the end of this. We're now that role. So we're going across not only the administration, the software side, but we're doing all aspects of a secondary. So connecting the buyers, bringing in the companies, and we always want to make sure that our position is that it has to be a company-centric transaction. If the company is on board from day one, my first thing to do is probably point them to their amazing legal counsel, which may be Reed Smith at times. And say, hey, you know, we have to make sure everyone is on board with this. Is this something that your law firm is okay with? Is it something your board of directors is okay with? Is it something your audit firm and valuation firm are okay with as well? And, you know, 9 times out of 10, it is completely okay, and that's when we get the transaction started. All right, so let's kind of talk about why we provide secondary liquidity, just in a general sense, right? So the #1 reason why I see companies, and I'm talking about the mid to late stage private companies, the ones that are valued at, let's say, $300 million or more as a private company, right? And they have roughly 100 or so employees, current full-time employees. So their #1 mission is to attract and retain talent. So if we kind of think about that, they're looking to say, how do we compete with Microsoft and Amazon and Google and Facebook, the ones where our employees are going and doing interviews and considering a role there, and those companies are telling them, hey, we're going to give you this awesome stock package, and once you've vested after a few months, you can go sell that into the public markets, right? You have an immediately tradable security. Whereas in the private companies, we have to remember, like, these employees are taking on a huge risk. They're joining a startup. They're probably giving up 12 hours of their day, if not more, working at these startups. Their gamble is their time, their money, their energy, and sometimes their early years of a career, right? Because as we all know, a lot of these folks are hiring the early stage, like the 20-year-old upward to 40-year-old, like the young folks that are like, hey, I'm hungry, I want to work at a startup, I want to build something. Like, that is the premise that these companies are living on, and so what they want to do is make sure that they're offering something that becomes very attractive to their prospective employees by saying, we're going to do this liquidity transaction. So attract and retaining talent is #1, the reason why we're doing these deals. So they're saying, hey, if we give these employees some liquidity now, we're telling them that it's an awesome incentive, we're rewarding them for being here, and then, hey, maybe in a year from now, we'll do another one of these transactions as well. But for now, we'll do one, we'll kind of see how it goes, and then see what the appetite is for all the parties involved for next year's transaction. So overall, it's a very good sign, it's a very positive sign, and we're excited to work with the companies in that capacity. And so then the reason why they also are offering the liquidity is streamlining the equity ownership. So what we see very frequently in a lot of these transactions is these companies are bringing in investors that'll take them through the IPO. And it's not necessarily that that's what they're asking for of us, is to bring investors that are taking them through the IPO, but it is absolutely a consideration. I don't know if I necessarily see a company that says, hey, we want this really active, trading mechanism where all of our investors could just buy and sell all they want. Sure, there are a couple companies like that exist, and there are reasons why they allow for that. But typically, these companies are looking for long-term investors who will stick around through at least a couple years, and then if not, to the IPO as a strategic partner. And then restructuring your equity plan. So the way that we work with companies, so we did retire our cap table and stock plan product, but what we do now instead is, once we do a transaction like this, we actually help them, we know exactly how to streamline their cap table so that we update it at the end of the transaction. We get it loaded into whatever platform they're using to manage their equity, and it seems as though nothing necessarily happened other than a few transfers. So we make it very easy to kind of get the process started and kicked off and ready to go, so that by the end of the deal, the company doesn't have to necessarily lift a finger. So that's overall very exciting as well. And I apologize if you can't really see this, I'll talk a little bit about it. So what this slide speaks to is just our overall volume of transactions and what it looks like. So as we know, what I'm talking about is company-sanctioned transactions, either by way of a one-off transaction involving maybe one seller, two sellers, a few sellers, or what we like to really recommend that the companies consider doing is a liquidity program, so an actual programmatic, episodic way to offer liquidity. So what this entails is that once the company says, hey, we're going to do liquidity, we're going to offer liquidity, we work with them to structure the program, and then the employees have typically what we call 20 business days where they are allowed to sell their shares into the transaction. So over 20 business days they have the opportunity to sell. NASDAQ brings in tax advisors. It's a whole thing. It's very cool. So over that course of that program, these employees are thinking about, well, do I sell? Do I hold? What do I do? So there's a lot of decisions to be made. And then at the end of that program, we do settlement, and it's all up and done within 30 days. So we do recommend this format for a number of reasons, but it's not necessarily always the way to go. I mean, if you don't have more than 10 sellers who are looking to sell their shares, it's not necessary that you do a program. You might want to just allow a few of them to sell, but then there's further impacts on stuff like the 409A valuation. And the 409A is absolutely important to all of these companies, and I'm happy to dive into that at a later date. So what I'm seeing in terms of transaction volume, I'm going to kind of go through this. So the first little graph there is it shows volume by program. So this is the dollar volume. And so what this is saying that the majority of our transactions are above $20 million, right? So the majority of these transactions we're doing are more than $20 million, and then some of them definitely do range in that $10 to $25 million range. And I think that this data actually is going to skew in the higher dollar range as we get through the rest of the year, because we just did 2 transactions where the total size was $1 billion. 2 separate company transactions, and one of them involved 33 investors from maybe 7 countries. So just all over the place. And then eligible shareholders by program. So here's the other cool thing about what we do at NASDAQ. So companies come in, they're controlling the whole process, they're dictating who could sell. The company always, even if they're doing it outside of NASDAQ, I always have to remind companies, company always can say who can sell and who can buy. At the end of the day, that's who controls the deal. Most of the time that these employees are involved, the companies are setting limits. So they're saying, if it's a current employee, they can sell up to 10% or up to 20% of their vested holdings. This doesn't necessarily mean they're exercised stock options that are now common stock. They're talking about vested holdings because our software actually allows for people to sell stock options on the same day that they're selling their shares, all in one deal. So it's like gross proceeds and then net proceeds, and in between there is something like the exercise cost. So it's really cool because historically what has happened is that if employees at a private company want liquidity, the companies say, well, that's great. Okay, you want liquidity? You've got to exercise your stock. Now you have common stock. And then you have 90 days to do that exercise. And a lot of employees in these private companies can't afford the exercise costs. They just can't. It's very steep. They're looking for a loan. I know we have wonderful folks here. We'll talk all about that soon. But inevitably, a lot of them just can't afford it, and they just don't know if they should take the risk of exercising their stock options. So when we do these transactions on our platform, we actually allow them to exercise and sell all in the same day, so they don't have to put any costs up for the exercise. So what this graph is telling you is that the majority of our shareholders were that companies involving at least 100 sellers. So about 100, there's some smaller programs going now, but overall when the company defines the criteria for who could sell, sometimes that minimizes the population of the employees, because what the companies will do is say, hey, you can sell 20%, 10% of your vested shares, but you also have to have been here for 2 years. So this is a way to say we're incentivizing, we're rewarding the employees who have been with us for a couple years, and maybe next year we'll do another one of these, or maybe in 6 months we'll do another one of these, and then maybe you'll be eligible by then based on your vesting schedule. So there's a lot of reasons and mechanics that go into these deals, and it's very interesting at the end of the day to see how many employees actually do participate. And then company valuation. So it says, I think that's saying 47% of our deals, the companies were valued at above $1 billion. That's right. So a lot of the unicorn companies are involved in these transactions. Quite frankly, and this is all personal, I would say that I think it's very exciting when you get the sub-unicorns, which I call the ponies, involved in these transactions, because I think the ponies are they're the next unicorns, right? They're the ones that will graduate to be Uber and graduate to be Airbnb. So those are the ones where I'm seeing a lot of interest from our buyers, from our investor networks, because those are the ones where they can come in at a really low valuation at a good price, and they're the ones that can grow with the company over time, which I think is super exciting. So overall, generally, yes, we are working with a lot of the unicorn companies, but going into later this year, as I see the pipeline and what's coming up, it's a lot more of those like $300 to $500 million companies that are interested in doing liquidity, because they're the ones who raised really big Series A and Series B rounds, and now they've been around for a few years, and so they have the employees who are looking for some form of liquidity. Okay. All right, so I'm going to talk about Q2 deals, because again, this is like the craziest quarter I've ever seen, so I'm happy to kind of talk about it. So the companies represented were Series A through Series F. So let's think about it. We've had Series A companies offering liquidity to a subset of employees. Like, it's really cool. It's showing that these Series A companies have been around for a couple years. They're looking to say, hey, it might not just be the founders that are selling, which is what we try to discourage just overall from a messaging perspective. But we've got employees that are looking to be here. They've been here for 3 to 4 years. How can we offer them some liquidity? And yeah, so there's Series A companies that are doing some of these transactions. It's not just the Ubers and Airbnbs anymore. It's the earlier stage folks. And then, yes, a large range of employees participating, right? So on the low end, we had around 50 employees participate on one of our transactions. And at the high end, we have 1,000 employees. And in August, I'm kicking off a transaction where it's going to be 1,600 employees selling in one of these unicorn companies. Just very cool. And then we have 3 companies over the age of 15 years old. So that's another thing. So some of you might know, after 10 years, a stock option in a private company actually expires. Like, you have to do something with that stock option. So what companies will usually do is encourage some form of liquidity through various outlets, but other times what we'll do is actually work with the company to structure a liquidity transaction. So for anyone who has options, hold those investors, probably in that negotiation phase, as we can all assume, said, hey, we're not going to raise $100 million, we're going to raise $120 million, and use $20 million of that to buy back the employee shares. The reason companies do this, there's a few, but ultimately it has a lot to do with why the company can control the price. They really want to control the price of the shares, and so they're doing this as a way to mitigate the back and forth negotiations it takes when you're bringing in an outside investor to buy the stock. So big example of this is SoFi. We just did this with SoFi. It was like 700 employees. They closed a huge round of funding, and the day after they announced the round closing, they announced to all of their shareholders that they were doing a buyback. And so it was very strategically crafted during that period, not only because they wanted to control the price, but also the reason why companies do these buybacks is because that means that they don't have to do a new 409A valuation, right? So if you're doing a new 409A just for a secondary, that might bump up the 409A value overall, but if you just did a primary round, you can actually apply that same 409A valuation to the secondary transaction we're doing in a buyback. So it means that there's no need to do a new 409A, and it usually always works out in that case. And then I had several companies, this is more than a handful, so I had several companies launch something called an option exercise extension program. So what that means is that, as I mentioned, so if you have stock options in a private company, and your private company is just kind of working along the standards, that means that the employees who have stock options, when the employee is terminated, they have 90 days to exercise their stock options. But what I'm seeing companies doing is that they're saying, you know what, we're not going to do 90 days, we're going to do 7 years, or we're going to do 10 years, which is the federal max. So companies are now offering this as what they call a benefit. I'm kind of subjective over whether or not I would actually call it a benefit, because there's different tax situations that occur after the 90 days. But I see a lot of companies instituting this as saying, hey, those employees don't have to exercise in 90 days. They can take 7 years to exercise their stock options. So they can pan out over whether the company is actually going to survive and keep going, and then decide to exercise their stock options. And so I had a handful of companies say, we're going to do one of these option exercise extensions, and we're going to do it on your platform. And then on the buy side, so I know that's very exciting for the room. So the buy side, roughly 70% of our third-party investor programs involved more than one buyer. So as I mentioned, I did have one company that involved 35 buyers, and that was very tedious. But the majority of the time, these companies are bringing in 1, 2, 3, 4 buyers to buy the stock. And usually the median buyer AUM, so the fund size of that buyer, is $4 billion. So just talking about like how large these buyers are, I mean, there's a lot of folks in VC that play in this space that are buying, but there are also private equity funds, there's smaller private equity funds. I'm seeing a lot of carve-out growth funds, so it might be like an evergreen PE fund, and then they're using some, you know, $100 million a growth opportunity fund to buy these shares. I am also seeing a lot of interest from sovereign wealth funds and family offices because, of course, we understand, we appreciate there's a lot of strategic initiatives that go into these. And we're happy to involve all of these folks in our universe. So the one thing that NASDAQ has to do when we involve buyers is that we do run a background check on everyone involved, the buy side, the sell side, the company. I'm seeing some pushback from buyers on this, but the minute I raise it to the company and say, hey, I'm seeing some pushback, usually the lawyers get involved, and it's a very interesting process how that pans out. But we have to run a background check. It's NASDAQ compliance, it's FINRA compliance, and SEC compliance. So if I have buyers who say, I don't want to go through that process, then you're tough out of luck, and unfortunately you're not getting involved in the transaction. So all of these deals we're running background checks, we're making sure everyone's legitimate, they're using legitimate funds, and there's no problem. So I do see some pushback from my international buyers, but after a few conversations, it does pan out. And then the buyers in our Q2 deals were represented by 8 countries overall, a lot of them in Asia, and then there were 3 continents. So you can understand that it's probably US, Asia, and everyone in Europe. So I am seeing some Europe interest, but I would say the majority of our buy side comes from Asia specifically. All right, so just in terms of like the NASDAQ Private Market platform, so this is our software side of the business where we're not doing any of the brokering. It's a private online portal, so how it works is that a company says, hey, we want to offer liquidity. If they need help sourcing the capital for the liquidity, that's where we'll get involved, and we've actually just started an initiative to start connecting capital to the companies directly for these deals. The company says we want to do it, we set up a platform, we issue the disclosure materials, so we won't even touch an opportunity unless the company gives full disclosure. So I mean, I need risk analysis, I need financials, I need a cap table. There's just a whole situation, and the companies have to be comfortable with providing that. We put that on the platform. If the buyers are interested in pursuing the deal, we'll connect them directly to the company, and they can negotiate that. And then we work with the company to facilitate it. So we determine who's eligible, how much are they going to sell, what's the offering price, right? And so the shareholders log in, the ones who are eligible, they log into the platform, they're like, oh gosh, these are all my holdings, I have 2 stock option grants, I have 1 common stock certificate, I might be an investor who's selling, I see my preferred stock, and then you're actually determining how much you want to sell from various certificates. It's pretty cool. On the sell side, it's really cool. On the buy side, on the platform, it's getting cooler by the day, but I would say the sell side experience is really fleshed out. So the employees actually also receive the funds directly to their bank account, and so they just plug in their bank account on our platform, and then at the end of the transaction, we send the net wires out to the employees. And we deduct any tax withholdings, so we do tax withholdings for the companies, and we also do the exercise costs. So if there was anyone exercising their stock options on the platform, we handle that and we send those proceeds to the company. And then, so essentially what this slide says is that they're offloading the administrative function to NPM because ultimately that's the whole goal, is that the company doesn't necessarily have to lift a finger. And so NPM's role in an employee liquidity program, so employee liquidity program in the context of this whole 20-day window I'm talking about, that's considered a private tender offer. I'm sure a lot of you are familiar with how a public tender offer works in the capital markets, but in a private tender offer, very similarly, it's a 20 business day window where it's episodic and everyone's selling a certain portion of their equity at the same price, right? So company works with us to upload everything into the platform. It's super straightforward. And then during the program, that's when the employees can sell some of their shares, wrap it up. They sign all the documents on the platform. And at the end of the transaction, so on the 20th day, that's actually when we work with the buyers to collect the proceeds. So the benefit, too, of working with NPM is that we're not looking to hold buyer funds in escrow for a month. No. We're working to hold your funds for a day. So we collect the net proceeds from the buyers and we calculate it down to the penny, so the buyers never have to send us more money than they're actually owed. It's actually also a compliance feature that we've had, so it's always a positive sign, because if the buyers all subscribe to buying like $20 million worth of stock and it ultimately ends up being just like 15 million, let's say, so the seller's only committed 15, the buyer doesn't need to send us 20. They can send us down to the penny what that 15 million looks like. So it's pretty cool. And then we work with the company to consolidate all the documents. Like I said, we update their cap table and stock plan at the end of the deal. And then we also work with the company to just figure out like any maybe employees that didn't participate, what were the reasons why they didn't participate. Usually it has something to do with the share price. A lot of the employees do feel like they can go out and find a better share price themselves. In that case, we tell the companies we're happy to work with those sellers as long as the company condones it, and then we'll help find the buyers for those sellers who might not have thought that they got the best deal in the transaction. So that's kind of end to end. We handle the entire process. And it's pretty interesting because what will typically happen in my world is I'll talk to a company and they'll say, we have maybe 2 people who want to sell, and then all of a sudden the floodgates open, and then come to find out there's 100 people that want to sell. So that's how these deals get very sizable very quickly, and it's really, really interesting to see them pan out. And then the fund disclosure page. So that's all I've got for you guys. Yes?
You touched on it, but can you talk a little bit more about price discovery?
Yes, price discovery. So what I tell the companies is that what you should always look at is the last round's preferred share price.